Hello everyone, we will be starting in around 8 minutes. Okay, so hello everyone, hope everything is going well. If you can just drop me in the message box, in the chat box, if you can hear everything and the screen is clear. Okay. So today we will be talking about, or basically the goal of this webinar is to spark your interest on how to master your risk management and how to react and understand decision making in order to become a successful trader in the market. So basically here we can see our main topic is risk management. So what is Forex risk management, or what's trading basically management? So Forex risk management comprises individual actions that allow traders to protect against the downside of a trade. More risks mean higher chance of sizable returns, but also a greater chance of significant losses. Therefore, being able to manage the levels of risk to minimize loss, while maximizing gains is a key skill for any trader to have. So basically, as a trader, every time we need to have a plan of risk management in order to have less losses and great profits. So how does a trader do this? Risk management can include establishing the correct position size, setting stop losses, and controlling emotions when entering and exiting positions. Implemented well, these measures can prove to be a difference between profitable trading and losing it all. So basically, whenever you're entering any trade, you have to be ready and to plugging in your stop loss and the position size, as in the lot size, and controlling your emotions. So your emotions should always be under what you are doing exactly now. So top 5 fundamental of risk management. We have the appetite for risk, position size, stop losses, leverage, controlling your emotions. We will be getting into each into more details. As we know, appetite for risk is exactly what's part of the risk. Position size, as we said, the amount or the lot size. Stop losses is how to plug in my stop loss. Leverage is the leverage I'm going to be using. And controlling your emotions is how to control my emotions and your emotions while trading. So appetite for risk, working out your appetite for risk is central to proper risk management. You should ask how much I'm willing to lose in a single trade. So every time you're willing to open a trade, what you think of is how much should I, or what exactly is the loss I'm willing to take in this trade. This is particularly important for the most volatile currency pairs, such as certain emerging market currencies. Also, liquidity in forex trading is a factor that affects risk management, as less liquid currency pairs may mean it is harder to enter and exit positions at the price you want. So basically, each time you want to enter a trade, and as we said, the volatile currency pairs like Euro USD, JPY USD, franc, Swiss USD. We have so many currency pairs that are very volatile that move a lot, even for the Canadian USD. So every time you get into this, you have to put the will, how much I'm willing to lose in this trade, because this will lead us to the stop loss. Now, if you don't know how much you are comfortable with losing, your position size may end up too high, resulting in losses that may affect your ability to take on the next trade or worse. So basically, if you don't plug in your stop loss and if you keep it open with not limiting yourself with how much you want to lose by chance, or if you don't control this, you will lose big amount, and this will not allow you to open another trade and will make you lose more and more. So let's say 50% of your trades are winners. In the long term, mathematically, you can expect to have runs of multiple losing trades in a row. Over a trading career of 10,000 trades, the odds suggest that you will face 13 sequential losses at some point. This underlines the importance of knowing your appetite for risk, as you need to be prepared with sufficient money on your account for one bad run set. So exactly what we are saying is that based on the amount that we put in our account, we can calculate the amount of loss we are willing to lose and how much is it, logically speaking, based on the money we are willing to put as capital in this account. So how much should you risk? How is the calculation basically? A good rule of thumb is to only risk between 1 and 3% of your account balance per trade. So for example, if you have an account of $100,000, your risk amount would be $1,000, $3,000. This goes back also if you have $10,000, $1,000, you just do this simply 1%, between 1% and 3%. This is the safest way. So position size, selecting the right position size or the number of lots you take on a trade is important, as the right size will both protect your account and maximize opportunities. To select your position size, you need to work out your stop placement, determine your risk percentage, and evaluate your pip cost and lot size. For more on how to do this, click on the link above. I will send you the link at the end, and you can check how do you do the calculations each time you want to open a trade, and then you can calculate it automatically. So whenever you want to enter this position, you look at the stop out where you want to put your stop loss, okay? And then you have to do the calculation of the risk percentage and evaluate the pip cost. Pip cost, if, for example, if gold increased by 10 pips, how much I will be making, it depends on the lot size and it depends on how much capital I have. So this is all based on formulas. I'll be sharing also a document at the end that will give you all the formulas that will help you in order to plug in your trade. So moving on into stop losses. Using stop loss orders, which are placed to close a trade when a specific price is reached. It is another key concept to understand for effective risk management and trading. Knowing the point in advance at which you want to exit a position means you can prevent potentially significant losses. But where is the point? Broadly, it's whatever point your initial trading idea is invalidated. So here exactly we can see using a stop loss order for managing trading risk. Here, for example, this is my buy position. Here I take my buy position, and here I plug in my stop loss order. Here I'm avoiding all this loss because as we can see, market went up, then I bought here, it went up, and then it went down. But I avoided all this part since I had this stop loss that was plugged in here. Traders should use stops and also limit to enforce a risk-reward ratio of 1-on-1 or higher. For 1-on-1, this means you are risking $1 to potentially make $1. Place a stop and a limit on each trade, ensuring that the limit is at least far away from current market price as your stop. So keep always a space, maybe $4 to $5, for example, in gold, $10. It depends on the market and depends on what's happening right now. So leverage in Forex allows traders to gain more exposure than their trading account might otherwise allow, meaning higher potential to profit, but also high risk. Leverage should therefore be managed carefully. So basically, as we said before in previous webinars, we were talking a lot about leverage. Leverage is something that the company provides for any trader in order for him or her to be able to trade on a larger scale. Why? Since if you wanna if you just invest $1,000, you can't even buy a 1 ounce of gold. Whereas when this company Gozo provides you with a leverage, it can be up to 1 to 400. This means that it will allow you to buy more than 1 ounce, and your profits will be based on this leverage, and your losses will be based on this leverage. The standard leverage is 1 to 100, so each dollar is $100. Each $100 is 1,000. So, how to control your emotions every time you are entering a trade? It's important to be able to manage the emotions of trading when risking your money in any financial market. Letting excitement, greed, fear, or boredom affect your decision may expose you to under risk. To help you take your emotions out of the equation and trade objectively, maintaining a trading journal or log can help you refine your strategies based on prior data and not on your feelings. So basically, every time you want to enter a trade, keep your feelings and emotions away. This will not make you any single part of trading journey or money. You have to keep your emotions away and just enter the market with analysis and strategy that you've built your trading on. We're gonna go into a small brief market overview. So here we go. Okay, so now as we can see, we saw a huge decrease in gold today, reaching 1916 levels. Here we can see Nasdaq increasing to 15,354. We can see US oil increasing. A few days ago it was around 80, now it's $83 per barrel. And we do have also US 30 for 35,535 right now. So basically what happened today, we had the CPI news that was coming out, and this CPI news is very important. So basically the results came out, and the data was issued showing inflation rising to 3.2% from the previous reading, which was 3%. And this is the scenario that we suggested in the morning. If you follow us on our Telegram channel, you would have known what we were saying. So the dollar will decline in a limited way, and the return to consolidation even after a while. Whether we like it or not, inflation has returned to rise in America after 13 months of continuous decline, and this will worry the Fed. In this case, the Fed now has another plan. This is a good indicator that we're back into inflation. This means the Fed should take into consideration that they might be increasing interest rate in the upcoming Fed meetings. And as we can see, that based on what last time we were talking about the NFP, also this CPI news allowed us to look at the market in another perspective and to see that what we are saying is really important, that news affect the market. Now we can see this huge drop in gold, which wasn't even expected. Now if we go now here to, excuse me, if we go, we can see this huge decrease for 1 hour candle. This is a huge decrease, and you can see this gradually decreasing. So basically this is for gold. Now we do also have US oil increasing, and then here we have the US 30, as we can see here. So now we're just gonna go also to a brief overview for what are the upcoming news for tomorrow, just to like discuss them more. As we can see here, the CPI news of today. Tomorrow, Friday, we have the core PPI and the PPI news, and these are very important. And we have also here consumer sentiment. But of course, tomorrow at 5:30 Dubai time, we can see here this news will be also important. Let's have an outlook for next week. Monday, we don't have any news, important news. Tuesday, we do have some important news, the Canadian CPI. We have the core retail sales. Wednesday, we have FOMC meeting minutes at night at 11 p.m. Dubai time. Thursday, we do have unemployment claims that will come out from the US. On Friday, we don't have any important news. The week after, we have some Euro news, the British pound news, USD news. We have unemployment claims. You can check them all through Forex Factory, and you can check them on our social media platform. Okay, so basically, we're just gonna do a recap for some people, how to open a trade as a trader if you are entering the market. What are the conditions and what are the things you have to do to open a trade? We have the sell and the buy. We have here the lot size. Of course, we can change it into 0.01, for example, which is 1%. We have 0. Excuse me, we have 0.1, which is 10%. Okay, this is the lot size. We have either we choose a position as sell, which is we are aiming that the market will go down, we press on sell. We have if the market is going up, we press on buy. We have the difference between these two numbers, 53 and 26, which is moving a lot. This is called the spread. This is the difference between the buy and the sell amount. This is how we can open a position. Here we choose the product that we want. For example, here's gold. Volume is the lot size. We can choose whatever we want, how many lot size. Stop loss, as we mentioned, please every time choose your stop loss. If you're targeting a sell, then the stop loss should be higher than the market now. If you're buying, then the stop loss should be lower than the market now. Take profit is where you are targeting or your target. For example, now gold is around 1916, 1917, and I'm willing to buy. Then my take profit would be 1920, and my stop loss would be 1910, for example. Okay, and then I either press on buy or sell. This is for how to plug in a trade. Now, how to read the charts. As we can see here, we have different time frames. We have 1 minute, we have the 5 minute, we have the 15 minutes, 30 minutes, 1 hour, 4 hours, daily, weekly. Basically, it depends on each one of you on which strategy he works or she works on. Most of the people use 4 hours candle to see how the market is clearly moving. Some people trade per minute. They trade very short term. Okay, and these are the candles. Now we can see when it's white, this means there's this decrease per minute, and the transparent one is the increase per minute. On the left here, we can see the market watch. We have all the products that you can trade with Goldu. We have more than 500 things to work to trade on: gold, silver, Nasdaq, US 30, Dow Jones, DAX 30. There are lots of currencies, pairs, metals, whatever you think of. You can also use, of course, through your mobile phone and check it out. So going back into our presentation, ending our presentation for today. So basically what we had to deliver today is how to manage your risk and what are the advantages of risk management and what is the idea behind you before entering any trade to manage your risk and how to control it. And you do have, please, on the left here, scan our barcode, this barcode on the left, to follow on our social media platform and join our Telegram channel to be updated with every news. On the right here, scan WhatsApp barcode, contact me if you need anything. And I'm more than happy and welcome to have a one-on-one session with any one of you. If you need to have a full, there's no limit for the time. You can have 1, 2, 3 hours of learning session, coaching session that will allow you in trading. Next week, we will be starting with a trading webinar that will be from A to Z it's like a weekly plan. And by the end, you will be getting a certificate that will give you a certificate that you learn the basics of trading. And then after this level, we're going to move into the intermediate and then to the expert level, hopefully. Thank you so much for joining. It was a good 30 minutes brief about risk management. Have a good day and continue your trading. I'm here to listen if you need anything and to help. And I'm more than welcome to hear if you have anything. Thank you so much.